Glad to have you here with us alongside Michigan's retirement coach, certified financial planner, Mike Douglas. I'm Heather Branch here asking Mike for his insight on what you can be working on to better prepare for your retirement and your financial future. So if you have questions, if you really need to get to work on a plan, by the way, your 401k is lovely and fat and large, but it is not a retirement plan, ladies and gentlemen. You need an actual plan. So michigansretirementcoach.com is where you can get started on that conversation. We also have links posted in the show notes. And what do you like to say? Subscribe to our YouTube channel.
Smash that like button. Just comment, be part of the community, be part of what we're doing. So, yeah.
Michigan's Retirement Coach. Search that on YouTube, and that's how you can find us there. All right. I'm surprised you don't have like a lab coat on or something. You said nerd so many times, pumping yourself up over this conversation.
So excited to nerd out today. It's gonna be great.
Sweating, bouncing in your chair a little. Let's talk about the idea of tax loss harvesting.
Let's go.
Let's do this.
Yes, I'm excited.
It's about time.
Right.
Okay, because the idea is we're in Q4 of 2024, and a lot of time people will talk about the idea of tax loss harvesting at this time of year, at the end of the year. But there was an article that I was reading talking about how this tax strategy is actually becoming more popular year-round, given the volatility that you can see in the stock market at any point in the year.
Yep.
So let's talk about the idea, the concept of what tax loss harvesting is, when we should be thinking about it, how you do it, et cetera, et cetera.
Yeah.
Please explain.
So let's start first with this understanding that tax loss harvesting is only for specific kinds of money. So in your retirement plan, you may have several different kinds of money. And the kinds of money are things like, I have a 401k for my job that I used to have. And then I rolled some of that over to an IRA. And maybe I have a Roth IRA. And I have this other account, this non-qualified, or a brokerage account, or a trading account, stock account. When it comes to tax loss harvesting, in your 401k, your rollover IRA, and your Roth, it doesn't matter, because those don't have a cost basis element that affects your taxes. Okay. Because all they care about in your pre-tax accounts are, when you take money out, you pay taxes on it, regardless of whether you made money, lost money in the stocks. They don't care.
Okay.
In your Roth IRA, you don't pay any taxes on the gains as long as it's been there past the 5-year rule. So we don't worry about that either. So tax loss harvesting is specifically for that fourth kind of money, the non-qualified or the brokerage account or your stock account. When you say, I've got this money that is just from my bank account that I ended up throwing into some stocks and it's built up over the years, or maybe you inherited money and you invested it and it's been there over the years. That's the type of account we're talking about, a non-qualified account, and how you have to pay taxes on it. So when you have that type of an account, there are different types of money. Now it's time to nerd out. I'm bringing up the tablet. We're going to look through some things.
Okay.
Because out of all this stuff, the goal is to minimize the effect taxes have on your retirement.
Okay.
Your life is the net. It's what's left after taxes. So if we can minimize how much we have to pay in taxes legally by all standards, and just pay when it makes sense for us, not for the government, that's the goal here. So that's what we want to do, is to dig into this. So let's pull up the tablet.
Okay.
And we're going to look through this for just a moment. So in this non-qualified account, and I should probably apologize right now for my handwriting, but hopefully this is educational and you can go back and watch it and understand it. So non-qualified money.
Okay.
It can be invested in two spots, either greater than a year or less than a year. Okay.
This is where you need to apologize to us for how bad your handwriting is.
Yeah, 100%.
Okay.
Imagine if you buy Apple stock today, okay, and you sell it less than a year from now. That's called a short-term gain or loss. And it is taxed completely differently. If you hold it past a year, it's considered long-term. And it's got its own separate tax system. So we need to understand that. First of all, there's short-term and long-term money. Did I own it for less than a year? Did I own it for longer than a year? Why does that matter? If you own it less than a year, it's taxed as ordinary. Your gains are taxed as ordinary income. So if you make money and let's say you fall in the 22 or 24% tax bracket, and you bought it for a certain amount, you sold it, the gains inside that are taxed at whatever your ordinary income bracket is. So 22, 24, 32%. Anything that's held longer than a year are taxed in a capital gains bracket. And those capital gains brackets are 0, 15, and the highest it can ever be is 20%. If your capital gains are basically 0 as a married couple, let's say 0 to 94,000, and this is your adjusted gross income plus your that.
Okay.
If you are less than $94,000, which means you're probably in a 12%, 0, 10, and 12% ordinary income bracket, your capital gains are taxed at 0%.
Okay.
It's a beautiful thing. So you can sell something, take income out of it, and pay 0 on the gains because you fell below that threshold.
If you had a net income of less than $94,000 and you owned that stock for over a year.
Right. And the rule here is your AGI, adjusted gross income, plus the gains.
Okay.
So if your adjusted gross income is $70,000, and then you sold something for $20,000 worth of gains, we add those 70 plus the 20, that's $90,000. You pay 0 capital gains tax on it. So that means you got $20,000 worth of gains you paid no taxes on, and you get to use it for income.
Got it.
The next bracket is basically from 94K. Again, this is for married filing jointly to about 500,000. It's really like $514,000.
Okay.
So 94 to $500,000.
That's a big range.
It's a big range. Is at 15%. That's it.
Okay.
Now, for example, 94,000 is actually where the 22% ordinary income bracket starts.
Okay.
So if you're selling it less than a year, you're paying 22%. Here you're paying 15.
Got it.
And the top bracket is basically 500,000 plus.
Okay.
So that is how these things are taxed separately. So we're only talking about your gains. So if you have this money, and I have some stocks, let's take a couple stocks. We're going to have Apple. We're going to have, let's say, Amazon. And you're going to have NVIDIA. All right, we have 3 different positions we bought. You as a person, maybe your combined income for the two of you, it's about $100,000. That is your AGI. You sell Apple stock after 250 days. You sell Amazon stock at 364 days. And you sell NVIDIA after 366 days. The gains on your Apple stock will be taxed at 22% because it's short-term ordinary income. The gains on your Amazon, because it's 364 days, will be taxed at 22% or more. Obviously, if your gains are high, then it'll push you in a higher bracket. Your gains on NVIDIA will be taxed at 15%, unless somehow your gains put you over $500,000.
Right.
So you can see it's quite a bit of savings just to hold on even 2 or 3 days longer sometimes.
Right.
And the point of this is tax loss harvesting.
Yeah.
Because now we're talking about only paying taxes, right? I sell, I have to pay taxes. But what if I have something that's lost money, right? So let's take this same example. You have Apple that is up, let's say, $20,000.
Yeah.
I have Amazon that is up $30,000. And I have NVIDIA that is down $50,000.
And this is all just hypothetical. This
all
is not
hypothetical.
necessarily what's happened this year. This is just, for example, if this were to have happened. Yeah.
Yeah. And let's say we've held them all long term. So we're past the point of a year because we don't want to pay those extra taxes. So we hold it longer than a year. In this space, right now, if I sell these Apple, I have to pay taxes, right? I have to pay that 15%. I have to pay 15% on here. But I have this loss. And I don't want to sell it at a loss because if I sell it at a loss, I lock in the fact that I lost money.
Yep.
However, sometimes it makes sense to say, you know what? If I sell this loss at $50,000, it offsets these gains. So I can take all of this money out. Let's say each one of these represents $100,000 of stock, right? $100,000, $100,000, $100,000. And you say, well, we'd really like to do an addition on the house and it's going to cost us 100 grand. Okay. Well, if you sell the Amazon stock for $100,000, I have to pay 15% in taxes. That's $15,000, right? Like there's things we have to account for.
Mm-hmm.
If we can offset gains with losses, I can pay 0 taxes.
So the idea is you would need to sell the stock that you lost on top of the stock that you gained on.
Yeah.
But when you do that with strategy, in certain cases, like you were saying, I mean, this doesn't sound like this is not super simple or easy. Like you got to know what you're doing. But when you know what you're doing and you have somebody guiding you along through this, you could really help yourself out.
Yeah. You can minimize the lifetime effect taxes have on your retirement. Because you have to be able to have these conversations. And that's where when you're working with an advisor or you're working with someone who's buying and selling stocks for you, they have to know these rules and laws because they could be making moves and not even realizing they're screwing up your plan.
Right.
We had one client, he came in and as we went through his tax returns over the past 4 or 5 years, which he said, that's interesting that that you want to look at my tax returns. You're a financial advisor. Well, I said, yeah, we want to understand your tax situation. We went through and realized that over the years, the last 3 years, he had paid taxes on money that he never took out. Someone was doing a lot of short-term selling, just trying to get into better positions, and every time accruing all these gains, but with no clue that there was that ordinary income. So it was pushing him into a 32% tax bracket federal on money he wasn't even taking out. So that was the problem when you go through this and we say, hey, you're paying all these taxes and you're not even getting the benefit of the money. Right. You didn't even build onto your house. You didn't go on vacation. You didn't buy a golf simulator. You didn't anything. You just ate that taxes at a highest rate possible. If those same stocks had been held past 1 year, you would have paid 15%. Or we could harvest them and offset with some losses and paid 0. But instead you paid 32%. And the government's not giving that back. That's something. It was a mistake by the advisor. That's an issue. We had another client who came in and she said that we couldn't do any tax harvesting because she had just sold a real estate property. Yeah. It was a rental they had, and she had $200,000 in gains on it because they had depreciated it down over 20 years. And she goes, so $200,000 in gains at 15% means I have $30,000 in taxes. Well, this is in 2023, right after a crashing year of 22. And we went through and found several long-term losses that could offset that gain. And so we went through and made some recommendations, and it wasn't quick. We had to dig out through her portfolio and do some research, but we were able to completely eliminate that $30,000 in taxes by offsetting with some long-term capital losses. It's a conversation that's worth having because it's your money and you get the net. And once you make these moves, the government doesn't say, hey, if you want to go back and fix it, we'll give you the money back.
Right.
They don't do that.
Right.
They're keepers. And so they're keepers and spenders. And so as a result, we want to make sure that before the mistakes are made, that we've looked at it. Right. So you can see just in these 2 examples with the 2 different clients, you want to pay a bunch of taxes on money you've never even seen, or can we avoid taxes on money you have seen, right? You bring in this chunk of money from selling a real estate property. Can we offset it so you pay no taxes and you get to keep all of the money? That is the goal of tax harvesting. It's to take a much more appropriate view of taxes. And again, I know we kind of nerded out a little bit in the weeds, but at the end of the day, we're really just trying to make sure that everything you've worked for over the years is yours and it's kept and it's for your kids. And right there in just 10 minutes or so, I gave a couple of examples of things that have to be calculated in every financial decision you make. And that is how a good retirement plan is built from the ground up. Taxes, investments, risk, quality investments, not just whatever investments, insurances, all these things have to be built into the plan. And so walking through this, understanding how your money is taxed, it's a powerful tool. And it's not just for the fourth quarter, right? It's not an end of year thing. It is good to do at the end of the year.
But it's something that you can be looking at all year long.
Oh, yeah. And we'll tell people, hey, we have an opportunity right now. We should make this move. Because sometimes you say, well, I got this construction project coming up and I don't do construction in Michigan in the winter. I'd like it done in the summer. Right. And so we need that money in the spring. Okay, well, let's start planning out and building it and taking advantage of it. Because if you're building a $50,000 or $60,000 barn and we can avoid 15 to 20% in taxes.
Mm-hmm.
I mean, otherwise, now we just turn that barn into a $65,000 barn, right? Or $20,000 or $70,000 barn. We don't want to do that. We want to bring those taxes down to keep it a $50,000 barn if possible.
Right.
So it's all part of the planning tool. When you're taking money out, when you're investing, when you're making decisions, taxes have to be at the forefront, and tax loss harvesting is a great opportunity.
A great opportunity that could be sitting right there in front of you. Unfortunately, if you are working with somebody who doesn't understand it themselves, how could you even know? So if you have questions about this, Mike and his team are here to help you get some answers, help you figure out which opportunities might be. MichigansRetirementCoach.com is where you can get started on that conversation. Again, we have links posted in the show notes, so you can just click there or find us anytime. MichigansRetirementCoach.com.